Hey, what's going on, guys? John Fibonacci here. Welcome back to the YouTube channel and welcome to this free series. This is going to be part 4, the terminology. All right. So now, again, this is for beginner traders. I do have a lot more terminology than this, but this is like the bare minimum of what I believe you should know. All right. So let's get right into it. All right, so first up is bullish or bull market. What is a bull market? What does it mean to be bullish? It is a market condition where prices are rising or expected to rising. So say if I tell you, hey, I'm bullish on the S&P 500, that means I think the S&P 500 will go higher. It is a bullish expectation or of higher pricing. So here's kind of a shaded area where price you can see generally is going higher. Although there's some retracements where the market does go down, overall the picture is higher pricing, which means we are in a bull market. Next up is a bear market. I meant to put that a little bit more over to the right. Sorry about that. But a bear market is a market condition where prices are falling or is expected to fall. So it's the opposite, right? If bullish means higher pricing, bearish means lower pricing. So we can see in this shaded area, we have a high and then we trade lower. We kind of consolidate for a little bit, then we trade lower again, retracement, and then we continue lower. So for the most part, during these multiple legs of price action, we were generally in a bear market. We see a lot more red, right? We see a lot more down candles than we do up candles. So we are bearish during these price points. Next up, we have the bid, ask, and spread. All right. The bid is the price a buyer is willing to pay for a security. The ask or the offer is the price a seller is willing to accept for a security. And the spread is the difference between the bid and the ask. So although this is important to know, it's not super crazy if you forget what this means. It just means if you trade Forex, okay, when you enter a position, it's automatically going to start off as a loss because there's going to be a difference between the buying and selling prices. Now, typically it's not going to be a lot. It might be 1, 2, 3, maybe up to like 5 or 6 pips. It won't be, too crazy, but there's still going to be a difference between what you can buy it at and what you can sell it at. And that is the spread. Next up is liquidity and volatility. So liquidity is the ability to buy or sell an asset quickly without affecting its price. Now, there is a lot more to that. But liquidity basically means how thin a market is. So for example, penny stocks aren't as liquid as, say, the S&P 500. So the S&P 500 is a very liquid market. The Forex market is very liquid because there's a lot of volume. Okay, so basically there's a lot of transactions. There's a lot of players in that particular market. Volatility is the degree of variation in the price of a security over time. Now that's pretty professional, but volatility basically means, let's say right here, you see this small segment in price that I'm highlighting right here. This right here, we don't have a lot of movement in one direction. The candles are very small. It's not really doing anything. But then you see how we trade lower and lower and the candles are getting larger, right? You see this particular down candle, it's very large compared to, say, these smaller candles in here. This area where price isn't doing anything, it's not very volatile. When the markets really start moving, or like say this up movement here, right? This green candle here saw a lot of volatility, whereas this red candle didn't see a lot of volatility. Okay, so that's probably a better, at least the way that I understand it, that's probably a better way than just the definition. But basically, if a stock doesn't move a lot every day, maybe 1% or less, it's not a very volatile stock. But say something like Tesla, for example, that might move 5 or 6% in a day, that's a very volatile stock. Next up, we have stop loss or SL, and we have take profit or TP for short. So a stop loss is an order to sell a security when it reaches a certain price to limit losses. If I buy a stock for $5 and let's say it goes down to $4, so I'd be losing $1 per share, and I don't want to lose more money, then it'll hit my stop loss. I'll sell it for $4 a share, and then I'll just take the loss and move on. It's a stop loss, right? So you're stopping potential like more losses. Say it might go down to, if I bought it for 5, I have a stop loss at 4, but let's say I didn't have a stop loss on, it goes down to 4, and then it goes down to 3 or even 2. Well, now I'm taking a much bigger loss. So we'll get more into risk management and stuff later on. But just know that a stop loss is very, very important, and it's to limit losses. Okay. Now a take profit or a TP is an order to sell a security when it reaches a certain price to lock in profits. So say, for example, I bought a stock for $5 a share, and then it goes to $7 per share. And I say, you know what? I can lock in $2 per share as a gain. So I'll sell it at $7. So when the market's at like 680, 690, and then it goes to 7, the market will trigger the order, and then I should get filled right around that $7 per share, and then I can, make money on that trade, and that's the idea. Okay. So a stop loss is basically if you buy, let's say we bought this asset here. Okay. I would put a stop loss at this low, so that way if it comes down to this low, it'll cut the losses. Or say I bought it here and it goes up to make a new high, I would have a take profit at this high, so that way if I bought it in here and it went up, I could sell it right above old highs. And again, more on stop loss placement and take profit or take partial and stuff like that. We'll get more into that later on in your trading career. Okay, you'll kind of know like where to not place your stop or where to place your stop and things like that, but that's beyond this video. Okay, so for now, just understand these are very important: stop losses and take profit. Next up, we have margin and leverage. So margin is borrowed money used to increase the potential return on an investment. So some derivatives, for example, like the futures market, there's a lot of leverage that's built into it. That's probably the wrong example, but margin is like in Forex, for example. You're not trading with a lot of money per se, let's say $500, but you can trade with a lot more money than that due to leverage. And that's what margin is. It's like borrowed money. Leverage is the use of borrowed capital to increase the potential return on an investment. Okay, so they're very similar. Now this is also what's dangerous too. Leverage can get a lot of traders in trouble. If you have a very small account, let's say just $500, $1,000, and you're trading a lot of leverage, you could lose that whole 1,000 like in one trade or even in a couple of minutes. So this stuff is what gets traders in trouble. This is how they blow an account, which means they lose all the money or most of it. So they have to deposit more money to keep trading. And it's very I think it's special for traders to go through, because people usually don't forget their first blown account, their first couple of blown accounts, right? And it's not fun, but that's what does it, is the over leveraging of your account. That's not what you want to do. All right, so that's what margin is, and that's what leverage is. Next up, we have pips and slippage. So pips is the smallest price movement in the Forex market, typically 0.0001 for most currency pairs. Slippage is the difference between the expected price of a trade and the actual price at which it is executed. So say, for example, same example as earlier, I want to buy a stock at $5. So I see that the market's right at $5. Say I buy it at the market, but I get filled at $5.02, right? 5.02, sorry. So that means I got slipped 2 cents per share. And slippage is a big deal for like day trades and stuff. I wouldn't be too worried about it. But that's what it is. It's where you expect to get something at the market. If you do a market order, I think that's next or shortly after. But a market order is where, you know, price is fluctuating and then you just buy it or sell it at the market, and it might slip you a little bit. And that's what that is. Okay. Oh, I guess that'll be a different video. All like the market, the types of orders and stuff, that'll be for a different video. But for now, if you guys want to check out some resources, there are more. I don't want to give you too much at one time, but these are some very good resources. TradingView.com. If you've watched the previous videos, you already know about TradingView. And you've probably already gone through the walkthrough as well. So hopefully you went through that and messed around with all the settings and stuff. CMEgroup.com, that's going to give you a lot of good information about the futures markets. You know, especially for like ES, YM, NQ, stuff like that. It's going to give you the margin requirements, the expiry dates, and all that other kind of stuff. Investopedia.com, that's where I got all the definitions from this particular video, right? I showed you Investopedia already. There's a dictionary over there, so you're more than welcome to either read it or go through it. If you want to, I suggest it. Barchart.com is pretty good. That'll also show you stuff like when futures contracts are rolling over and all that kind of stuff. More on that later. And then forexfactory.com is important as well. So I don't know if it'll be the next video or the one after that or the one after that, but eventually we're going to get into stuff like news, the calendar, right? The news calendar. And that's where Forex Factory really comes in. So you just want to make sure to check that out right now before we get to that video. So just that way you're a little bit more familiar with that before we get there, so it's not too brand new. Okay, so TradingView, CMEgroup.com, Investopedia, Barchart, and Forex Factory. All right, so with that being said, thanks guys for watching. Thanks for being here. I appreciate you. Don't forget to drop a like if you got some value. And I meant to put this in other videos, I guess I forgot, but if you have any questions, you can send me a DM on Instagram at John Fibonacci. So I will do my best not to ignore you. I pride myself on getting back to everybody in the best way that I can. I usually do. So yeah, if you have a question, send me a DM, or you can comment right here on this YouTube video and I will get to your questions, hopefully in a timely manner. All right. So with that, drop a like, share the video with some friends, share the playlist with some friends if you want to, you know, help spread the value. All right. So thanks guys. And I'll see you in the next one.